could there be a hidden gem, maybe, in the world of blank check companies? A lesser-known investment vehicle that offers potentially massive leveraged gains.
Or is it just, another really high-stakes gamble, especially in a market known for being so volatile?
Exactly. We're diving deep into U.S. SPAC warrants today. And honestly, the data we've gathered, it might just surprise you. It reveals this really stark contrast between how these warrants perform compared to the very stocks they're tied to after a merger.
Yeah, it's definitely a corner of the market that, well, it absolutely exploded in popularity a few years back, then cooled off dramatically.
Right.
But it still holds some fascinating intricacies, I think.
Yeah.
SPACs themselves were, well, quite the phenomenon, weren't they? Channeling huge amounts of capital.
Huge amounts.
But within their structure lies this component, the warrant.
Yeah.
Which, based on the analysis and the sources you've got there, it seems to behave quite differently. And, in some periods, potentially offer some unique opportunities.
But alongside those significant risks you mentioned earlier.
Oh, absolutely. The risks are very real, no question.
Okay, let's try and unpack this then. Our mission, really, in this deep dive is to explore U.S. SPAC warrants using the sources you've shared, articles, research papers, discussions, anything that sheds light on this.
Sounds good.
We want to understand precisely what they are, how they trade, and crucially, why their performance after the merger seems to tell such a different story than the common stock. And then, delve into the mechanics of that leveraged potential, untangle the kind of complex layers of dilution.
Which are definitely complex.
Yeah, examine the surprising historical performance data, look at a real-world case study, and maybe most importantly right now, understand the growing landscape of litigation and regulatory scrutiny they face.
Exactly. And the material we have, it gives us a pretty comprehensive look, I think. Starting from the real basics, just defining what a warrant is in this specific context, all the way through to, detailed empirical studies analyzing performance, and then the legal perspectives on the current, well, let's say challenging environment.
Definitely sounds challenging.
It's a complex area, for sure. Grasping the nuances is absolutely essential for anyone even thinking about looking at this space.
Okay, so let's start right at the very beginning, just for clarity. What exactly is a SPAC? And then where do these warrants fit into that picture?
Okay, so SPAC, it stands for Special Purpose Acquisition Company.
Yeah.
The easiest way to think about it is like a shell company.
A shell, okay.
Yeah, it's created with really only one specific purpose. Raise capital through an IPO, an initial public offering, and then use that money to acquire or merge with an existing private company.
So it's got the cash first, then finds the company.
Exactly. The ultimate goal is to take that private company public, maybe more quickly, maybe with more certainty than a traditional IPO might offer. It's basically a structure designed to reverse merge a private company onto a public exchange using that pre-raised cash.
Got it. So a company with a big pool of cash, basically on the hunt for a private company to bring public, and the warrants, how are they connected?
Right, the warrants. They're contractual instruments, and they're typically issued right at the SPAC's IPO, usually as part of the units offered to investors.
Units.
Yeah. So when investors buy a unit, which is often priced at a nominal value, say $10, they usually get one share of common stock and a fractional warrant. Maybe half a warrant, maybe a fifth. It varies.
Okay, so it's a bundle deal.
It's a bundle. And this warrant, it grants the holder the right, but really important, not the obligation to purchase a specific number of shares of the combined company's stock.
After the merger happened.
After the merger, exactly.
Yeah.
At a predetermined price, that's the strike price, and within a defined period.
So it sounds a little bit like a stock option then.
There are similarities, definitely, yes.
Yeah.
Both give you the right, not the obligation, to buy stock at a set price.
Right.
But there are key distinctions that make warrants pretty unique in this context.
Like what?
Well, unlike standardized options you trade on an exchange, SPAC warrants are issued directly by the company itself.
Ah!
And that means their terms can vary quite a bit from one SPAC to the next. You absolutely must read the specific prospectus for each SPAC's warrants to understand the exact terms.
So things like how many shares one warrant lets you buy.
Exactly. The precise strike price, the expiration date. And this is critical. Any clauses that allow the company to force warrant holders to exercise early. That's a big one.
Right, we'll come back to that. But why would a SPAC include warrants in its initial offering in the first place? What's the incentive for them?
It's primarily a way to make those initial IPO units more appealing. A sweetener, really.
The sweetener.
Yeah, to attract a broader base of investors, both the big institutional funds and individual retail investors. By bundling shares with warrants, the SPAC offers investors potential additional upside.
So if the company they merge with does well.
Right. If the stock price performs well after going public, the warrants can become quite valuable. It offers a potential profit path separate from just holding the common shares. It's basically a way to make the deal more attractive and fill up that trust account with cash.
Okay, so just to quickly recap the essential characteristics then. If you hold warrants, you typically don't get voting rights.
Correct. No voting rights.
Or dividends.
No dividends either, not until you actually exercise the warrant and convert it into a share.
Okay, and the warrant price, it generally tracks the stock price.
Generally, yes, it tends to move with the underlying common stock, but not always perfectly. Especially before the merger is finalized, there can be disconnects.
And they're volatile.
Oh, highly volatile. Just like many SPAC stocks themselves, the price can swing dramatically, up or down.
And a major risk, I guess, is if the SPAC just fails to find a merger target.
It's a huge risk. If the SPAC fails to find a target within its mandated time frame, usually about 2 years,
right,
and it has to liquidate,
then the warrants are just
essentially worthless. Or very close to it, because there's no underlying company, no stock to buy. The whole premise disappears.
Wow. Okay. That liquidation risk is definitely something to keep in mind.
Absolutely non-trivial. And, many SPACs from that boom period, they are actually approaching their deadlines now and are struggling to find suitable targets or get mergers completed. So it's a very current risk.
You also mentioned an early redemption clause earlier. That sounds important.
It's critical for warrant holders. Most SPAC warrants have this provision baked into their terms.
Well, how does it work?
It typically states that if the price of the common stock trades above a certain threshold, often it's around $18 a share for a specified number of trading days.
Like consistently high.
Yeah, frequently something like 20 trading days within a 30-day period. If that happens, the company can notify warrant holders and basically force them to exercise their warrants within a pretty short window, usually about 30 days.
Force them. So you lose the choice.
You lose the choice of when to exercise beyond that window. If you don't exercise or sell your warrants within that 30-day notice period, the company can often redeem them from you for a nominal amount, like maybe a penny or even a tenth of a cent per warrant.
So they basically become worthless again.
Practically worthless, yes, even if the stock price is way above the strike price.
So unlike holding a long-term option where you decide when to exercise before expiry, the company can essentially just accelerate that whole timeline if the stock does well. You have to be really vigilant and ready to act fast.
Precisely. Missing a redemption notice, maybe you weren't paying attention, or the notice went to spam, it means your potentially valuable warrants could just evaporate overnight. Poof.
Okay, understanding those specific terms is clearly vital. Let's move on to the practical side then. Trading and valuing these things. Can you actually buy and sell SPAC warrants easily, like regular shares?
Generally, yes. Once those initial units split, the warrants get listed on stock exchanges, usually with their own ticker symbol. Often it has a W or WS at the end to indicate it's a warrant.
And they're liquid, easy to trade.
They are typically quite liquid, yeah. You can buy or sell them on the open market at the prevailing market rate anytime before they expire or get called for redemption. It's pretty similar to how you'd trade common stock.
Okay. And are they available on all brokerage platforms? Like, could I trade them on Robinhood?
Not universally. And this is actually an interesting point that came up in the sources. Some popular retail platforms, like Robinhood, as you mentioned, explicitly do not allow trading in SPAC warrants.
Why not?
Well, the stated reason is often related to concerns about complexity and risk. Worries that retail investors might not fully grasp the nuances, particularly those forced redemption clauses we just talked about. However, most of the major full-service brokerages, think Schwab, Fidelity, Interactive Brokers, they generally do offer access to warrant trading.
And does that limited availability on some platforms affect anything?
It potentially can, yeah. It can sometimes create situations where the market price of a warrant might lag its theoretical value relative to the common stock. It could lead to temporary disconnects, maybe even opportunities for those investors who do have access on platforms that allow trading.
So the brokerage landscape itself can kind of create pricing inefficiencies. Interesting. Speaking of value, why wouldn't a warrant's market price perfectly track the stock price minus the strike price? Like if the stock is trading at $30 and the strike is $11.50, Why wouldn't the warrant just automatically trade at $18.50?
Right, that $18.50, that's what we call the intrinsic value. It's the immediate profit you'd make if you could exercise the warrant and simultaneously sell the stock right that second.
But it doesn't always trade there.
Often it doesn't, especially before the De-SPAC deal actually closes, or sometimes even immediately after. The market price often trades at a discount to that intrinsic value.
Why the discount?
Well, the market builds in other factors, things like time risk, basically, the uncertainty about whether the stock price will stay at that $30 level or maybe even go higher before the warrant can actually be exercised or sold profitably.
So the risk it could fall before you act.
Exactly. Plus, there are still a lot of unknowns floating around during the merger process itself. The sources use the example of SHLL, that was the SPAC ticker, before it merged and became HYLN, Hylan.
Right.
Before that merger closed, SHLO stock price went absolutely nuts. It soared on speculation.
I remember that one.
Yeah. And its warrants traded up significantly too, but, and this is the key point, they didn't fully track the stock's incredible ascent to its peak relative to that $11.50 strike price.
Right.
There was this noticeable gap. You can look at it and say, theoretically, the warrants were undervalued compared to the stock price at that moment.
Right.
Shortly after the merger actually happened, the HYLN stock price collapsed dramatically. So the fact that the warrant price didn't fully reflect that peak intrinsic value beforehand, you could argue maybe in retrospect that the market was implicitly predicting that the stock's crazy price might not hold.
So the warrant price already had some doubt baked in.
Kind of. The warrant price had a premium for the potential upside and the time left before expiry, sure. But it also carried a discount, reflecting the very real risk of the stock falling, which it ultimately did, dragging the warrants down with it, despite how undervalued they might have looked relative to the stock's temporary speculative peak.
That makes a lot of sense. The market isn't just looking at today's snapshot. It's constantly baking in expectations and risks about the future, especially with all the volatility and uncertainty around that whole De-SPAC process.
Precisely.
Okay, let's try and make the potential profit and that leverage concept really concrete. Can we use an example from the source material? I think there was one about LCA.
Yeah, the LCA, which became Golden Nugget Online Gaming example, is a good one for illustrating this.
Okay, so say I buy 1,000 LCA warrants at $6 each. That's a total investment of $6,000. Then after the merger, the stock price does really well and goes up to $30. How would I figure out my potential profit?
Okay, let's break down the two main ways you could realize that gain, and we can really see how the leverage plays out.
Okay, method one.
Method one. You just sell the warrants themselves on the open market. If the stock is at $30 and the strike price for your LCA warrant is, let's say, standard $11.50.
Right.
Then the intrinsic value is $30 minus $11.50, which equals $18.50 per warrant. Now, assuming the market is pricing the warrants sufficiently at or very close to this value, say exactly $18.50, and you sell your 1,000 warrants.
I'd get $18,500.
$18.50 times $1,000. Yes, $18,500. So your profit from just selling the warrants would be those proceeds minus your initial cost. $18,500 minus the $6,000 you paid. That's $12,500 profit.
Okay, pretty straightforward. Sell the contract itself.
Okay.
What's the second way?
Method two is you actually exercise the warrants to buy the common stock, and then you sell those shares.
Okay.
So to exercise your 1,000 warrants, you'd need to pay the strike price, $11.50 for each one. That's 1,000 times $11.50, which is $11,500 cash you need to put up.
Right, plus the $6K I already spent on the warrant.
Exactly. So your total cost to actually acquire those 1,000 shares is the initial warrant cost, $6,000, plus the exercise cost, $11,500. Grand total,
Right.
$17,500.
Okay, $17,500 out of pocket in total.
Right. Now you own 1,000 shares, and your effective cost basis per share is $17.50. $17,500 total cost divided by 1,000 shares.
Got it.
Now, if you turn around and sell those 1,000 shares on the market at the current price of $30 each, you receive 30 times $1,000, which is $30,000.
Okay.
Your profit is then $30,000 minus your total cost of $17,500, which again is $12,500.
Huh. So the dollar amount of profit is exactly the same, $12,500, whether I just sell the warrants or I go through the exercise and sell shares process. So where's the leverage you mentioned? I'm a bit confused.
The leverage isn't in the final dollar profit amount, assuming the warrant trades at intrinsic value. The leverage is in the initial investment required to achieve that profit potential.
To explain that.
Think about it this way. To make that same $12,500 profit by buying and selling the shares directly, assuming you somehow bought them at $17.50 and sold at $30.
I would have needed to invest $17,500 up front to buy those 1,000 shares at $17.50.
Precisely. But by using the warrants, You were able to control the exact same upside potential, the profit from 1,000 shares, moving from $17.50 to $30 by initially investing only $6,000. Just the cost of the warrants.
Wow. Okay, I see now. My initial capital outlay, the actual cash I had to put down first to get in the game, was way smaller using warrants compared to buying shares directly to capture that same $12.50 per share gain.
Exactly. That's the core of the leverage. You gain exposure to the price movement of the underlying stock, but with a much, much smaller initial investment. You only need the cash for the strike price, that $11,500 in the example, if you actually choose to exercise.
And I don't have to exercise.
You don't have to. As Method 1 showed, you can simply sell the warrants themselves to capture the gain without ever putting up that strike price cash. And that is why warrants can offer such potentially massive percentage returns on your initial warrant investment if the stock price performs well above the strike.
That example makes the leverage potential incredibly clear. It really is a leveraged bet on the De-SPAC entity stock doing well, significantly above that strike price. Okay, now let's get into how these are initially offered and tackle that critical issue of dilution you mentioned earlier. It all starts with the SPAC unit, right?
It does, yeah. At the SPAC IPO, investors typically aren't just buying shares, they're buying these units. And they're often priced right at $10 per unit, which basically reflects the cash that goes into the trust account.
And a unit isn't just one share.
Usually not. It's typically a package deal. It commonly consists of one share of common stock and a fraction of a warrant.
And that fraction varies.
It varies quite a bit, yeah. We've seen examples in the sources ranging from, say, 15th of a warrant per unit, sometimes 13, sometimes 12, even more complex structures. Like, remember PSTH, Pershing Square Tontine Holdings?
Bill Ackman's big SPAC, yeah.
That one was interesting. Its unit initially included only 19th of a warrant per unit, but it also had these additional potential rights tied to future events after the merger. So structures can get creative.
And these units, they don't stay units forever. They eventually split.
Yes, almost always. After a certain period post-IPO, maybe 52 days is common, or sometimes triggered by a specific event, like announcing a merger target, like signing a letter of intent, an LOI.
They break apart.
They automatically separate or split into their constituent parts, the common shares and the warrants, and then these start trading independently on the exchange, each with its own ticker symbol.
Right. And the PSTH example just shows how varied those structures can be, not just in the warrant fraction, but adding other potential bells and whistles.
Exactly.
Now, I remember hearing some buzz maybe a while back about a potential sort of arbitrage strategy involving these units. How did that supposedly work?
Yeah, the so-called risk-free or maybe low-risk arbitrage play. The idea was to try and exploit the fact that the unit price often trades very, very close to that $10 cash value held in the trust account before a merger target is even identified.
So buy the unit at $10.
Right. Buy the unit at or near $10, wait for it to split into the common stock and the warrant, and then immediately sell the common share for hopefully around $10.
And keep the warrant.
And keep the warrant. Since the warrant came as part of that $10 unit package, if you could successfully sell the share for $10, the warrant felt like you got it for free, or at least very, very cheaply.
But did it actually work like that? Was it really risk-free?
Well, the sources point out it wasn't always that straightforward and definitely not truly risk-free. A big issue is liquidity. The trading volume in the common shares before a deal is announced can often be really low.
So it might be hard to sell.
It could be hard to sell quickly, or you might face wide bid-ask spreads. So you might not actually be able to sell your common shares at exactly $10. You might sell them for $9 or get hit with transaction costs. And suddenly those free warrants actually cost you something. The perceived low cost could evaporate pretty quickly.
So the practicality of pulling off that arbitrage really depended heavily on having enough market liquidity for the common shares before any deal excitement kicked in.
Makes sense. Okay, let's tackle dilution head on now. You mentioned warrant exercise dilutes existing shareholders, but dilution in SPACs, it actually starts even earlier than that, doesn't it?
Oh, absolutely. And it's a critical factor. It significantly impacts the actual value for common shareholders who decide to stay invested through the merger, the ones who don't redeem. Dilution in a SPAC structure really comes from two main sources: the sponsor promote, and then the warrants and any other rights.
Okay, start with the sponsor promote. What's that?
So the team that forms and manages this SPAC, the sponsors, they receive a pretty significant ownership stake in the combined company after the merger. This stake is typically structured to be equivalent to about 20% of the total capital raised in the initial IPO.
20%. just for setting it up and finding a deal.
Essentially, yes. It's their compensation, their incentive for creating the SPAC, doing the work to identify a target company, and then executing the merger transaction. So let's use an example. If a SPAC raises, say, $1 billion in its IPO at $10 a unit, the sponsors effectively get shares equivalent to $200 million in value right off the bat.
That's the general idea. Yeah, think about it. When the SPAC IPOs at $10 per unit, that $10 represents the cash sitting in the trust account. For investors who hold their shares all the way through the merger and don't redeem, the value they're bringing to the deal is their portion of that trust money.
Right.
But once the merger is completed and the target company becomes the new public entity, the equity ownership in that new combined company gets split. It's split between the original SPAC investors and the sponsors. So if the IPO raised $1 billion and hypothetically no one redeemed, that $1 billion from the trust goes into the combined company's assets.
Okay.
But now the ownership of that company is roughly 80% held by those original investors and 20% held by the sponsors. That 20% sponsor stake, which was effectively created as part of the initial structure, means the value per share for the original investors gets immediately diluted.
How so?
Because instead of their share representing, say, $10 worth of the trust assets in the new company, it's now effectively representing only $8 worth from the moment the sponsor promote is factored into the post-merger ownership structure. That's a built-in 20% dilution effect just from the sponsor promote itself. And that's before a single warrant even gets exercised.
Okay, wow. So that 20% sponsor slice automatically reduces the per share value for the original investors who stick around. Now, how do the warrants add more dilution on top of that?
Right. Warrant exercise is the second major layer of dilution. When warrant holders decide they want to exercise their right, pay the strike price to buy common stock, they pay cash into the company. Yes.
Which sounds good. More cash for the company.
It is more cash. But in return, the company issues brand new shares to those warrant holders. These new shares increase the total number of outstanding common shares in the combined entity.
And more shares means each existing share is worth less. Essentially, yes. For the existing common shareholders, it's dilutive because their percentage ownership of the company decreases as the total share count goes up. Imagine the company's equity value is like a pizza. Each share is a slice. When warrants are exercised, the company cuts new slices and gives them to the warrant holders. Now there are more slices in total. So the original slices your shares represent a smaller percentage of the whole pizza.
Okay, that makes sense. And is this where high redemption rates become particularly painful for the shareholders who didn't redeem?
Exactly. This is a crucial point that the sources really highlight. High redemption rates, meaning lots of initial investors taking their $10 back, they amplify the per-share dilution effect, especially from the sponsor promote, for those shareholders who remain invested through the merger.
How does that amplification work?
Let's go back to that $1 billion IPO example. Suppose 50% of the initial investors redeem their shares. They take $500 million in cash out of the trust account.
Okay, so only $500 million goes into the merger now. Right. Only $500 million from the trust is available for the combined company. However, the sponsors still get their 20% ownership stake in the new combined company. That 20% promote is now effectively being applied to an entity that received much less cash from the trust. But the sponsors still get their full percentage cut of the whole thing.
So their 20% is a bigger fraction of the value brought by the remaining investors.
Exactly. It concentrates the sponsor promote's dilutive impact onto a much smaller base of remaining investor shares. This significantly increases the per-share dilution for those who did not redeem. And the sources indicate that redemption rates are often very high. One study mentioned an average of over 92% redemption among shareholders in their sample.
92%. Wow. So the scenario where most of the trust cash is withdrawn is actually pretty common.
Very common, especially in certain market periods. This leaves the remaining shareholders exposed to really substantial dilution, first from the sponsor promote being applied to a reduced cash base, and then potentially from warrants later on.
So high redemptions mean less cash goes into the combined company, but the sponsors still get their fixed 20% cut of the post-merger entity. That effectively makes their 20% slice come out of a much smaller pool of equity contributed by the investors who stayed in. That sounds like a powerful dilutive force for those non-redeeming shareholders.
It really is. The cash contribution from the trust ends up being much lower than the initial IPO headline amount, while the sponsor's equity piece remains fixed as a percentage of the new entity's total equity. This dynamic, combined with any future warrant exercise dilution, creates a really complex and often challenging picture for common share value after the merger.
Okay, given all these factors, especially that significant dilution, how have de-SPACs actually performed in the market after the merger? Let's look at the historical data the sources provide, starting with the common stocks. What does the track record look like?
Well, the performance picture for stacked common stocks during that de-SPAC period, meaning the time after the merger is done and the former target company is trading publicly, is, on average, pretty bleak. That's according to the research you provided.
Bleak how?
One comprehensive study looked at a large sample of SPACs from 2012 up to 2021. They found consistently negative average returns for investors who just held the common stock after the merger.
Consistently negative.
Yeah. The average 12-month buy and hold return for these de-SPAC stocks in their sample was minus 10.4%.
Minus 10% over a year on average. Ouch.
And looking out even longer, the average 36-month buy and hold return was still negative. It was minus 6.9%.
So just buying and holding the stock post-merger has, on average at least, been a losing proposition based on this historical data. How does that stack up against, say, traditional IPOs? Are they similarly bad?
Traditional IPOs tend to have a different profile. While their longer-term post-listing performance can certainly vary a lot, historically, they've often shown, modest average first-day returns. A different source mentioned that U.S. IPOs between 1980 and 2022 had an average first-day pop of around 19%.
19% on day one.
On average, yeah. SPACs, on the other hand, typically have much smaller, often near zero, average first-day returns right after the merger. And critically, unlike the consistently negative average long-term performance seen in de-SPAC stocks over months and years in that study, the long-term picture for traditional IPOs is generally considered less negative on average, although, again, performance varies hugely by year and company.
Okay, so average returns for de-SPAC stocks looks significantly negative, contrasting pretty sharply with some historical benchmarks for traditional IPOs. But here's the twist we hinted at earlier. What about the warrants from those same de-SPAC companies?
Right. This is where the data gets really surprising, as highlighted in the research. The exact same study that found those consistently negative average buy and hold returns for the SPAC stocks.
Yeah.
It found positive average returns for the SPAC warrants from those same companies over the same de-SPAC period.
Positive? How positive?
Their analysis showed an average 12-month buy and hold return for the warrants of plus 22.8%.
Plus 22%. Compared to minus 10 for the stock.
Exactly. And extending that time frame out to 36 months, the average buy and hold return for the warrants was plus 27.8%.
That's truly counterintuitive. How on earth can the common stock of a company, on average, lose value after a merger, while the warrants of that same company which derive their value directly from the stock actually gain value on average over the same period? It doesn't seem to add up.
It seems completely paradoxical on the surface, doesn't it? Yeah. Now, another study mentioned slightly different numbers, but still showed positive average buy and hold returns for warrants in their sample. I think it was like 64.4% over 1 year and 113% over 3 years.
Even higher averages.
But, and this is an important caveat they pointed out, the median returns for warrants in their study were actually negative. Minus 10.5% for 1 year, minus 5.9% for 3 years.
Okay. So the average is pulled up by some big winners.
Exactly. It suggests that those high positive average returns are likely heavily skewed by a few warrants that performed spectacularly well. The typical warrant experience, the median one, might still have been negative, which really underscores the high volatility and the kind of binary nature of these things. Potential for huge gains, but also potential for near total losses.
Okay, that median context is important. But still, even with that caveat, the average performance of warrants is a really striking deviation from the underlying stock's average performance.
Yeah.
The picture is definitely different, and the average is notably positive for warrants.
Definitely different, yes.
But are these just raw returns? Do these figures account for risk? I mean, maybe warrants are just inherently much, much riskier, and that's why their average return is higher. Does that explain it?
That's the critical next step in the analysis. And the sources definitely dive into this by examining risk-adjusted returns. They use standard fundamental models like the Fama-French three-factor model, which try to account for the return you'd expect based on known systemic market risks. Things like overall market movements, whether a company is small cap or large cap, and whether it's a value stock or a growth stock.
So, adjusting for those typical risk factors, what happens when they apply that to the de-SPAC common stocks?
When they apply this framework to the de-SPAC common stocks, the studies generally find that the returns, even though negative on average, are largely explained by these standard risk factors. There's typically no significant evidence of positive risk-adjusted excess return, what academics call alpha, on the stocks.
So no alpha for the stocks.
Generally, no. This finding implies that, from a risk-adjusted perspective, the market seems to price SPAC common stocks relatively efficiently around the time of the merger. You're basically getting the return or lack thereof that's commensurate with the standard risks you're taking on.
Okay, so the stock returns, while poor on average, seem to be roughly what you'd expect given their risk profile according to these models. But what about the warrants? What happens when you apply the same risk adjustment analysis to them?
This is where the research uncovers a potentially really significant finding. The studies do find evidence of positive, statistically significant, risk-adjusted excess return on SPAC warrants during that De-SPAC period.
Positive alpha for the warrant.
Yes. The Bergen study, for instance, reported a statistically significant weekly alpha for warrants, somewhere in the range of 0.8% to 1.3%, and significant at the 5% level.
Wow. That's a notable finding.
It really is. It suggests that even after you account for those traditional market risk factors, SPAC warrants, on average, appear to have outperformed what their risk profile alone would predict according to that model. The implication: they might be systematically undervalued by the market at the time of the merger.
So hang on. The market seems to price the stock correctly based on its risk, according to the models, but it potentially misprices the warrant, which is literally derived from that exact same stock.
That is fascinating. What on earth could be driving this apparent market inefficiency or this really unusual behavior in warrants?
Yeah, connecting the dots from the data, the research points pretty strongly towards one specific factor as being a key driver of this positive risk-adjusted excess return, this alpha found in warrants.
What factor?
The redemption ratio.
The percentage of shares redeemed before the merger.
Exactly. The studies find a statistically significant relationship between the percentage of initial SPAC shares that are redeemed for cash before the merger closes and the subsequent risk-adjusted performance of the warrants after the merger.
Okay, and what is the relationship? Higher redemptions mean? A higher redemption ratio, meaning a larger chunk of the original investors decided to take their $10 back from the trust instead of rolling your investment into the new company, is associated with a higher positive risk-adjusted excess return on the warrants of that specific SPAC after the merger.
Wait, that seems completely backwards. Based on our earlier discussion, high redemptions are bad, right? They deplete the cash going into the company. They amplify the dilution for the shareholders who stay. Why would the warrants perform better in a scenario that sounds like it should be detrimental to the underlying common stock's value?
This is absolutely the puzzle, isn't it? And the source material explores a few possible interpretations for this seemingly paradoxical finding.
Like what?
Well, one possibility is simply that some parts of the market maybe don't fully grasp or don't correctly price in the implications of these large redemption ratios, specifically for the warrants. Maybe they overfocus on the negative signal for the stock and miss something about the warrants.
Maybe. What else?
Another explanation ties back to the strategies of certain types of investment funds. You sometimes hear them referred to in discussions, maybe a bit colloquially, as the SPAC mafia.
Ah, yes. The funds that invest at the $10 IPO price, specifically intending to redeem their shares but keep the warrants?
Exactly those. These funds often subscribe to the SPAC units at the IPO, knowing full well they have the right to redeem their common shares for their initial $10 back, plus any interest earned right before the merger closes.
So they get their principal back risk-free, essentially.
Pretty much. And they also receive the warrants as part of that initial $10 unit package. They often view these warrants as having been acquired very cheaply, or sometimes even as a free kicker, alongside their low-risk cash investment in the shares.
Okay.
Now, this strategy becomes highly profitable, precisely in a high redemption scenario. They successfully get their principal back on the shares, and they get to keep the warrants, which, according to this data, seem to perform particularly well exactly when redemptions are high.
So are you saying the trading behavior and the specific investment strategies of these large players' strategies that are actually facilitated by the redemption feature might be creating or at least contributing to the market dynamics that lead to this apparent positive alpha in warrants, particularly in those high redemption SPACs?
That's certainly one plausible interpretation that emerges from the analysis, yeah. It suggests that even though high redemption reduces the cash going into the business combination and intensifies that sponsor dilution for the remaining common shareholders, somehow the warrants seem to benefit from this dynamic, at least based on the observed historical performance data.
It suggests the market might be underestimating the value or the potential upside of warrants in companies that saw lots of investors head for the exits via redemption, maybe focusing too much on the perceived weakness signaled by those exits.
That could be a part of it. It certainly raises some really intriguing questions about market efficiency during that complex, often messy De-SPAC transition period.
Definitely. Did the studies find any other factors that seem to influence warrant performance besides the redemption ratio?
Yes, they did note some sector-specific influences as well, at least within their sample period. For instance, SPACs that merged with companies in sectors like, say, travel and hospitality, and also automotive, tended to show a positive impact on the warrant returns during the period studied.
Why those sectors?
Well, it's hard to say definitively, but it could potentially be linked to changing market expectations or recovery narratives in those specific industries around that time. Perhaps exacerbated by the economic shifts and adaptations happening during and after the COVID-19 pandemic. Maybe investors were pricing in higher future values or recovery potential into the warrants for companies in those sectors.
Interesting. It's fascinating to see how these broader sector trends can kind of layer onto the specific structural dynamics of SPACs and warrants. Okay, to try and ground all this abstract data and mechanics, let's look at a specific high-profile case study from the sources. Churchill Capital 5 and its merger with Lucid Motors. That was a big one.
Oh yeah, CCIV and Lucid. That's a prime example from the absolute height of the SPAC boom in 2020, 2021. It really illustrates some of these wild market dynamics we've been talking about.
So remind us, who is behind Churchill Capital 4?
Churchill Capital 4, or CCIV, was a SPAC sponsored by M. Klein & Company. This was a group led by Michael Klein, and they already had a track record with some earlier successful SPAC deals, like Clarivate and Multiplan, so they weren't new to the game.
And their target was Lucid Motors, the electric vehicle maker.
That's right, Lucid Motors, an EV manufacturer positioning itself as a competitor in the luxury EV space.
And Lucid was one of those companies, right? Capital-intensive, pre-revenue. Maybe would have found a traditional IPO pretty challenging at that stage.
Precisely. At the time of the merger talks, Lucid wasn't profitable. I don't think they were even projected to generate significant revenue until maybe 2022. That kind of profile, it can definitely make the intense scrutiny and the whole process of a traditional IPO more difficult. It could potentially delay things or maybe limit the amount of capital they could raise.
So the SPAC route was appealing.
Appealing because it offered Lucid the ability to raise a very large sum of capital relatively quickly, and maybe with more certainty around the valuation and timing compared to the traditional IPO path. Plus, it allowed them to tap into the public market excitement for EVs through that SPAC structure.
Okay, tell us about the Churchill Fee IPO itself. When did it happen? How big was it?
Churchill Capital Phi listed on the New York Stock Exchange on July 30th, 2020. It's a pretty big one, raising $1.8 billion. And like most SPACs, its units were offered at that standard $10 price.
And the unit structure.
Each unit consisted of one share of common stock and a fraction of a warrant. Specifically, it was 1/15 of a warrant per unit. And the strike price for a full warrant was the typical $11.50.
Okay, standard structure. And then the market excitement began, right? Even before any deal with Lucid was actually announced.
Oh, absolutely. Trading in the Churchill 5 units and then later separately in the shares, CCIV, warrants, CCIVWS, started around September 2020. Initially, the stock price hovered around that $10 trust value, as you'd expect. But then, rumors and intense speculation started swirling that Churchill IV was targeting Lucid Motors. This wasn't confirmed news, just rumors. But it triggered an absolute buying frenzy in the CCIV stock.
Frenzy.
The share price just exploded. It surged over 500% in a matter of weeks, hitting a peak somewhere near $65 a share, based almost entirely on that merger speculation. Pure hype.
Wow. A really dramatic example of hype driving price way, way beyond the $10 trust value or even any fundamentals at that point. So what happened when the deal was finally confirmed? Did the price go even higher?
Nope. When the merger with Lucid Motors was officially announced on February 22, 2021, you saw that classic SPAC pattern play out, maybe more dramatically than usual. Sell the news. The share price immediately plummeted from those speculative highs. It dropped sharply, falling all the way back down toward the low $20 pretty quickly.
So massive run up on the rumor, huge drop on the actual news. What was the final structure of that deal when it was announced?
The merger transaction valued Lucid Motors at an implied enterprise value of around $24 billion, which is a huge valuation. Churchill Capital, the FEAT, contributed its cash from the trust, which was about $2.1 billion by then, including interest earned.
Okay.
But to give the combined company even more capital to fund its growth plans, they also secured a really substantial PIPE investment alongside the merger.
A PIPE, private investment in public equity.
Exactly. They raised an additional $2.5 billion through this PIPE from a group of very prominent institutional investors. Big names like BlackRock, Fidelity, Franklin Templeton, Neuberger Berman, they all participated. That PIPE was absolutely crucial in providing the necessary capital for the newly public Lucid Group.
Yeah, that $2.5 billion PIPE on top of the SPAC cash is a huge amount of funding. The Churchill-Ivy-Lucid case really is a perfect illustration, isn't it? It shows the speculative mania SPACs could attract, the incredible volatility driven by rumors versus confirmed news, and also how the structure, especially when combined with a large PIPE, could facilitate really significant capital raising for ambitious companies like Lucid.
It absolutely captures both the intense excitement and, frankly, some of the more irrational, volatile nature of the SPAC market during that peak period, particularly regarding investor behavior and those wild price swings before and right after a major announcement.
Okay, now let's pivot to the challenges. Because while the SPAC market was absolutely red hot back in 2020 and 2021, the sources you provided indicate things have changed. A significant cooling down, definitely, but also, importantly, a major increase in legal and regulatory pressures.
That's a really critical shift in the whole landscape, yeah. The volume of new SPAC IPOs, well, it just dropped off a cliff. The sources note that as of August 2023, only something like 22 SPACs had listed that year, raising maybe $3 billion total, which is just a tiny fraction compared to the hundreds of billions raised annually during the peak year.
It's brutal compared to the flood.
Exactly. And at the same time, we've seen a significant uptick in both civil litigation and regulatory enforcement actions specifically related to these De-SPAC transactions. The parties seem to end, and the cleanup, or maybe the reckoning, began.
What kind of trends are we seeing in the civil lawsuits? What are they about?
Well, first, there's just been a substantial volume of them. Securities class actions filed against the De-SPAC companies themselves, and often against their directors and officers, too. The sources cited, I think, 33 such lawsuits filed in 2021, another 24 in 2022. So a lot of activity.
And what are the main allegations in these suits?
They often center on allegations of inadequate or misleading disclosures made during the merger process, particularly concerning the target company's actual business, its financial health, its future prospects. Sometimes claims of breaches of fiduciary duty by the SPAC leadership. Were they really acting in the best interest of shareholders when they approved the deal?
And have these lawsuits actually resulted in significant financial consequences? Are companies settling?
Yes, absolutely. The settlements have often been quite substantial, which signals just how serious these claims are being taken. The sources give several examples. Akazu, for instance, settled a securities class action for $35 million. That was related to allegations of insufficient due diligence by the SPAC and also alleged fraud concerning the target's business metrics.
$35 million. Okay.
Then there was Triteris. They settled for $9 million over claims involving inadequate disclosures about related party transactions, always a sensitive area. Multiplan, which was one of Michael Klein's earlier SPACs actually, reached a $33.75 million settlement related to allegations they didn't adequately disclose risks concerning their relationship with a key customer.
Another big one.
Yeah, and TradeZero settled for $5 million following a merger that actually failed, where the plaintiffs alleged fraud had occurred. So these settlements really highlight the common litigation risks. Maybe failures in due diligence on the target company, inadequate or misleading disclosures in the merger, proxy statements, and sometimes issues arising from deals that just fall apart.
So the legal system is definitely putting the pressure on players in the De-SPAC space, holding them accountable for alleged shortcomings. What about the regulators, specifically the SEC, the Securities and Exchange Commission? What have they been doing?
The SEC has significantly ramped up its scrutiny of the entire SPAC ecosystem, really starting back in September 2020. They made it clear this was an area of focus. And then in March 2022, they took a big step by proposing a comprehensive set of new rules and amendments specifically targeting SPACs and De-SPAC transactions.
New rules. What was the goal?
The main goal really was to enhance investor protection by requiring much more robust disclosures. They wanted to bring the regulations around SPACs closer to those for traditional IPOs.
What were some of the most impactful proposed rules in that package?
Well, several key proposals stood out. They wanted mandatory disclosures on really complex areas like the details of sponsor compensation and economics, how much the sponsors are actually making, Also, better disclosure of potential conflicts of interest throughout the whole process. And clearer explanations of those significant dilutive effects we talked about earlier, which often weren't well understood.
Making the dilution impact crystal clear.
Exactly. They also proposed requiring SPACs to obtain and disclose fairness opinions about the business combination, basically, an independent assessment saying if the deal price is fair. And perhaps most significantly, they proposed eliminating the traditional safe harbor protections under the Private Securities Litigation Reform Act, PSLRA, for forward-looking statements, specifically things like those often optimistic financial projections made by the target company during the De-SPAC process.
Whoa, removing the safe harbor for projections, that sounds like a massive shift.
Yeah.
Companies often rely heavily on those projections to justify the deal valuation, right? This could mean much higher liability if those projections don't pan out.
It is potentially a very big deal, yes. And it was definitely a point of significant debate and pushback during the public comment period for these proposed rules. The aim seems to be to level the playing field between SPAC mergers and traditional IPOs, where companies are generally much more constrained in the types of forward-looking statements and projections they can make during the offering process.
So make SPACs more like IPOs in terms of liability for projections. Have those rules been finalized yet?
As of the time of the source material, the final rules hadn't been adopted. The comment period was extensive, faced some technical glitches requiring reopening, so the ultimate form and timing of any final rules remains subject to the SEC's ongoing process. But the direction of travel towards tighter regulation is clear.
Okay, so tighter rules are likely coming, but beyond just proposing rules, has the SEC already taken concrete enforcement actions against SPACs or related parties?
Oh yes, they have been actively pursuing enforcement actions and securing settlements for alleged violations. The sources mentioned several examples. The SEC reached an $8.04 million settlement with Momentus, that was the space company, and also its founder.
What were the charges there?
The charges allege they'd misled the SPAC about the actual viability of their technology and also about related national security concerns. And critically, the SEC also charged that the SPAC itself had failed in its due diligence obligations to actually verify those claims made by Momentus.
So fault on both sides, target and SPAC.
Exactly. The SEC also charged an investment advisor, Perceptive Advisors, who paid a $1.5 million settlement for failing to disclose conflicts of interest. Apparently, they were advising both a SPAC and also a different company that eventually merged with a different SPAC, creating a conflict they didn't disclose.
Conflicts of interest are a big focus then.
Definitely. And more recently, there have been reports of enforcement actions against entities like Digital World Acquisition Corp., DWC. The SPAC planning to merge with Trump's media company for alleged material misrepresentations in their filings. And even insider trading charges brought against individuals connected to a different SPAC deal involving a firm called Rocket One Capital.
Okay, so it's abundantly clear that the legal and regulatory environment surrounding SPACs and De-SPACs has become significantly more challenging, much riskier than it was during the frenzy.
Absolutely. And while the flood of new SPACs has slowed to just a trickle, it's important to remember there were still hundreds of SPACs out there that were active and searching for targets or facing their combination deadlines as of late 2023, according to the source material. So for those sponsors, for target companies considering a SPAC merger, and for investors looking at this space, navigating this environment where litigation risk and regulatory scrutiny are much, much more prevalent than they were just a few years ago is absolutely critical.
Okay, so after this really detailed deep dive into the world of U.S. SPAC warrants, what does it all ultimately teach us? What are the main takeaways?
Well, I think it really shows us that SPAC warrants are far from being just some simple or peripheral element of the whole SPAC structure. They're a distinct and actually quite complex investment vehicle in their own right.
And they offer that significant leverage potential we talked about.
Exactly. That leverage is key. It allows investors to gain exposure to the potential upside of a post-merger company, but with a much smaller initial capital outlay compared to buying the common stock directly.
And then there's that historical data you presented, which offers that really surprising, almost paradoxical picture.
It really does. It highlights this notable divergence. While the average returns for the SPAC common stocks after the merger have been consistently negative in the data we looked at, the average returns for their corresponding warrants have, perhaps surprisingly, been positive.
And potentially even positive on a risk-adjusted basis.
Yes. Furthermore, the research suggests that warrants may have exhibited positive risk-adjusted excess returns, that alpha, implying they might have been systematically undervalued by the market right after the merger. And that phenomenon seems potentially linked, according to these studies, to those complex market dynamics surrounding high share redemption ratios and the specific investor strategies that leverage that feature.
And this is as with any highly leveraged investment, this potential for outperformance seems to come hand in hand with some very, very significant risks.
Oh, absolutely. You cannot forget the risks. There's the high probability of the warrants just becoming worthless if the SPAC fails to complete a merger. There's the inherent volatility, which is amplified by that leverage. There's the complex and substantial dilution from both the sponsor promote and the warrant exercise itself, which, as we saw, gets magnified in those high redemption scenarios.
And now, layered on top of all that,
is the very real and increasing legal exposure, both from civil lawsuits brought by disgruntled investors and from stepped-up regulatory enforcement by the SEC. The whole landscape is just much tougher.
So the key lesson here isn't just about looking at those average performance data points, is it? It's more about the need for a really deep understanding of the whole structure and all the intertwined risks.
Precisely. Investing in SPAC warrants, or even just evaluating them, requires going way beyond the headline potential gains. It really demands a thorough understanding of the specific warrant terms. Reading that fine print is crucial. You need to grasp the mechanics of the whole De-SPAC process, the detailed implications of dilution under different redemption scenarios, and you absolutely have to be aware of the current intensified legal and regulatory landscape. It's become a high-stakes environment that really rewards granular due diligence and a keen awareness of all these complex moving parts.
Okay, so here's maybe a provocative thought to leave you, our listener, with as you consider this complex market. Given that historical data showing average positive returns for warrants, even while the stocks of the same De-SPAC entities were negative on average, and given that compelling suggestion from the research that redemption dynamics might be a key driver for this difference, does this imply there's been a genuine and maybe even a persistent market inefficiency in how SPAC warrants are priced right after the merger? Or alternatively, will the increased legal scrutiny and those proposed tougher SEC regulations inevitably sort of iron out these potential mispricings? Will they force warrant performance in the future to more closely mirror the often negative trajectory we've seen in the underlying stocks?
That really is the multi-billion-dollar question, isn't it? Whether that apparent alpha was a temporary anomaly of the boom or something more structural that might persist, or if regulation will effectively eliminate it. The market and investor behavior within it is always adapting, and the regulatory environment for SPACs is clearly still in flux. How these pressures ultimately reshape the warrant market and its future performance characteristics, well, that's something that really remains to be seen.
It's certainly a dynamic area and one that bears watching, particularly as those remaining SPACs out there navigate their combination deadlines under this much heightened scrutiny. Well, thank you for joining us on this deep dive into U.S. SPAC warrants. We really hope this detailed exploration has provided you with some valuable insights into their mechanics, their surprising historical performance, and of course, the very significant risks involved.
Thank you. It's always fascinating to explore these complex corners of the financial markets in detail. Understanding the nuances is just crucial for making informed decisions.
Absolutely. We encourage you to continue exploring these fascinating and often challenging financial topics. Until next time.